I know China's become a controversial topic lately, but while most Aussie investors are still on the sidelines, China's stock market has rebounded almost 30% since the low in April, and a major opportunity could be unfolding that reshapes your portfolio in 2025. The smart money is moving back to China, and they've been making some incredible technological breakthroughs. DeepSeek's AI model disrupted global AI pricing. Unitree Robotics is pushing humanoid robots under $6,000, and Ehang just became the first company to get commercial certification for passenger flying cars. But buying mainland Chinese stocks directly is still tricky for Aussie investors. Even though they are more accessible now through Hong Kong's Stock Connect, most local brokers don't offer it, and the process involves complex FX transfers, offshore accounts, and limited trading windows. But the China ETFs I'm about to cover give you professionally managed exposure to Chinese companies here on the ASX. They're traded in Australian dollars and as easy to buy as any other Australian stock. In this video, I'm breaking down 5 key China ETFs every Aussie investor should know. We'll look at the fees, the top holdings, and most importantly, the sectors they target, so you can confidently decide how to tap into the Chinese market through the Australian Stock Exchange. The 5 key China ETFs. Now, there are 5 key ETFs that I want to focus on today, and each one gives you a different angle on the Chinese market. Let me break them down for you. First, we have the VanEck FTSE China A50 ETF. The ticker is CETF. This one's pure China, and it focuses on the top 50 companies listed on the Chinese mainland exchanges. The fee is 0.6% per annum, and it has about 36 million under management. The top holdings include Guiqiao Mutai, Cattle, China Merchants Bank, BYD, and Ping An Insurance. The manager is VanEck. Now, Cattle are developing 500 watt-hour per kilogram condensed cells aimed at electric aircraft, potentially enabling commercial e-aviation in the next decade. They're years ahead of the competition. And BYD is now shipping electric vehicles into Europe and have become the biggest selling electric car company in the world. These aren't just Chinese companies anymore. They're global leaders in their sectors. What's interesting about this ETF is that it gives you access to iShares. These are the shares that were traditionally only available to Chinese domestic investors. Next up, we have VanEck China New Economy ETF, and the ticker is CNEW. This one focuses on the new economy companies in China. The fee is higher at 0.95% per annum, but it's got about 106 million under management. It's also run by VanEck. The holdings are quite different. Companies like Eptolink Technologies, Victory Giant Technology, Broadtex Technologies, and Rockchip Electronics. These are the companies that are driving China's technological transformation. If you believe China is going to lead in areas like 5G, AI, and advanced manufacturing, this is where you want to be. These smaller, more innovative companies are the ones pushing the boundaries of what's possible. Now, we first started covering CNEW in our newsletter in late July, and it went on to move almost 15% in under 30 days. To learn more about which ETFs could potentially be next to break out, click the link in the description. The third option is Betashares Asia Technology Tigers ETF. The ticker is Asia. This one's interesting because it's not just China. It covers the best technology companies across Asia. The management fee is 0.67% per annum, and it's got about 824 million under management. The top 10 holdings include Taiwan Semiconductor, Samsung Electronics, but also Chinese giants like Tencent, Alibaba, and Xiaomi. The manager is, of course, Betashares. One thing I like about Asia is you're not just buying consumer apps, you're getting exposure to firms bankrolling next-gen robotics. For example, Alibaba and Tencent are investors in Unitree Robotics, which recently unveiled a sub $6,000 US humanoid robot, the R1, and it's targeting roughly a $7 billion listing on Shanghai's STAR market. When you buy this ETF, you're getting exposure to companies that are literally funding the future of robotics. And the fourth option is the Global X China Tech ETF, DRGN. This one's a pure play on China's fast-growing technology sector. The management fee is 0.5% per annum, and it has about $28 million under management. Its top holdings include names like Alibaba, Tencent, and Xiaomi, alongside high-growth innovators such as Hygon Information Technology, East Money, Meituan, NetEase, Zhongji Inolite, BYD and Eptolink Technology. The manager is Global X Management. DRGN gives you target exposure to major Chinese tech firms, many of which are expanding globally across sectors like e-commerce, EVs, and advanced manufacturing. It's up over 20% since we started covering it in our newsletter 2 months ago. And finally, we have iShares Asia 50 ETF. The ticker is IAA. This one's got the lowest management fee at 0.29% and has nearly $1 billion under management, making it one of the largest. The top holdings include Taiwan Semiconductor, Tencent, Samsung Electronics, Alibaba, Xiaomi, AIA Group, China Construction Bank, and DBS Group. And the manager is iShares or BlackRock. The beauty of this ETF is the low cost and broad diversification across Asia's largest companies. Sometimes the simplest approach is the best approach, and with a fee of 0.29%, it's hard to argue with the value proposition. So the question is, which ETFs should you choose? Let me break down the key differences so you can make an informed decision. On fees, IAA is the clear winner at just 0.29%, followed by DRGN at 0.45%, then CETF at 0.6%, Asia at 0.67%, and CNEW is the most expensive at 0.95%. Remember, fees matter over the long term, so this is an important consideration. On sector focus, you've got different approaches. Asia and IAA give you broad Asia exposure with heavy tech weightings and significant China components. CETF gives you the pure China exposure to the largest mainland companies. CNEW targets China's new economy and innovation-led names. DRGN is a concentrated play on Chinese technology companies, semis, hardware, and internet leaders. On market access, CETF is the most direct China A-shares play. CNEW and DRGN include mainland A-shares via Stock Connect, while Asia and IAA lean more on Hong Kong, Taiwan, Korea, and other regional listings. On diversification, if you want pure China, CETF, CNEW, and DRGN are your options. If you want China as part of a broader Asia strategy, Asia and IAA make more sense. On company size, CETF focuses on the biggest Chinese blue chips, while CNEW tilts to smaller, more innovative companies. DRGN blends mega cap platforms with faster growing tech manufacturers. Asia and IAA give you a mix of large and mid caps across the region. The key is understanding what you're trying to achieve. Do you want pure China or China within a broader Asia allocation? Do you prefer established giants or higher growth innovators, especially in tech? Pick the ETF that matches your goals. So there you have it, the 5 key China ETFs available to Australian investors. But knowing which ETFs are available is only half the battle. The real question is which one is positioned to break out first and when to make your move. That detailed timing analysis is exactly what goes into my weekly newsletter. For example, we started covering the Asia ETF 3 months ago and it's up over 13% since then, outperforming the ASX 200 index, which is only up 5%. If you want access to this kind of analysis, try my newsletter. It's $40 a month with a full 4-week free trial. Click the link in the description to learn more, and I'll see you next time.